You've probably noticed that rich people seem to get richer while everyone else is working harder and harder just to stay in the same place. You're putting in the hours, you're being responsible with your money, but your bank account isn't growing the way you hoped. Meanwhile, wealthy people seem to multiply their money effortlessly while barely lifting a finger. Here's what nobody tells you. Rich people don't actually work harder than you do. They're not necessarily smarter or more talented. What they do differently is how they use their money. While most people trade time for money, wealthy people make their money work for them, and they do it in very specific ways that most of us never learn about. Today I'm going to pull back the curtain and show you exactly how rich people actually invest their money. And more importantly, how you can start using the same strategies, even if you're not rich yet. Let's start by addressing the biggest misconception about wealthy investors. Most people think rich people are constantly trading stocks, watching charts all day, and making complicated moves that require insider knowledge or special access. That's not true at all. In fact, most wealthy people have surprisingly simple investment strategies. The difference isn't complexity, it's mindset and consistency. Wealthy people view money as a tool to create more money, not just something to spend or save. Every dollar they have is put to work generating returns, and they think in terms of decades, not days or months. This long-term thinking, combined with specific investment strategies, is what creates and maintains wealth. One of the first things you need to understand is that rich people diversify, but not in the way you might think. When most beginners hear about diversification, they think it means owning different stocks. But wealthy people diversify across entire asset classes. They don't just own stocks. They own real estate, businesses, bonds, sometimes commodities like gold, private equity, and various other investments. The idea is that different types of investments perform well at different times. When stocks are down, real estate might be up. When everything is volatile, bonds provide stability. By spreading money across multiple types of assets, wealthy people protect themselves from any single investment tanking their entire portfolio. Now, you might be thinking, I don't have millions to spread around in all these different things. And that's fair, but the principle still applies, even on a smaller scale. You can invest in real estate through REITs, which are basically stocks that represent real estate holdings. You can own bonds through bond funds. You can own businesses through stock market investments. The point is to think beyond just one type of investment. Let me talk about how wealthy people approach the stock market specifically, because this is eye-opening. You'd think rich people are constantly buying and selling, trying to beat the market and find the next big winner. But study after study shows that most wealthy investors do the exact opposite. They invest in broad index funds and hold them forever. Warren Buffett, one of the richest investors in the world, has repeatedly said that for most people, including wealthy people, low-cost index funds are the best investment. His advice for his own wife's inheritance is to put 90% in an S&P 500 index fund and 10% in bonds. That's it. No complicated stock picking, no timing the market, just boring index funds held for the long term. The reason is simple. Trying to beat the market is incredibly hard, and even most professionals fail at it. But capturing the market's returns through index funds is easy and has historically produced excellent results over long periods. Here's something crucial about how the wealthy invest. They're almost never emotional about it. When the market crashes and everyone is panicking, wealthy investors often see it as a buying opportunity. They have the cash reserves and the mental fortitude to invest more when prices are low, which is when you get the best deals. Meanwhile, most regular people panic and sell, locking in their losses. This difference in behavior during downturns is one of the biggest wealth dividers. Wealthy people can afford to think long-term because they're not living paycheck to paycheck. They have emergency funds, they have multiple income streams, so a market drop doesn't force them to sell. They can wait it out, or better yet, buy more at discount prices. This is why building an emergency fund and having financial stability is so important before you start investing heavily. It gives you the psychological freedom to invest like a wealthy person instead of being forced to make emotional decisions. Let's talk about something really important that wealthy people do differently. They invest in assets that produce income, not just assets that might appreciate in value. What does this mean? They buy rental properties that generate monthly rent, buy dividend-paying stocks that send them checks regularly. They invest in businesses that produce cash flow. They want their investments to pay them while they hold them, not just hopefully be worth more someday. This is the concept of passive income, and it's how wealthy people fund their lifestyles without having to work traditional jobs. Imagine owning rental properties that bring in $5,000 a month in rent after expenses. That's $5,000 you're earning without trading your time for it. Or imagine having a stock portfolio that pays you $3,000 a month in dividends. That's income you can use to reinvest, to cover living expenses, or to fund the lifestyle you want. Most beginners only think about whether their investments go up in value, but wealthy people think about cash flow. Here's another strategy wealthy people use that most people never consider. They invest in themselves and in their ability to earn more. Before they invest heavily in stocks or real estate, they invest in education, skills, networking, and businesses that increase their earning power. Think about it. If you invest $10,000 in the stock market and earn 8%, you make $800 in a year. But if you invest that same $10,000 in learning a high-value skill, starting a side business, or getting a certification that leads to a promotion, you might increase your annual income by $10,000 or $20,000. It's a much better return, and it's money you can then invest in traditional assets. Wealthy people understand that their biggest asset is their ability to create value and earn money, so they invest in that first. They take courses, hire coaches, attend conferences, build relationships, and constantly look for ways to increase what they can earn. Let me talk about taxes for a minute, because this is huge, and most people completely overlook it. Wealthy people are obsessed with tax efficiency. They don't just think about how much they're making. They think about how much they're keeping after taxes. They use retirement accounts like 401ks and IRAs to invest with tax advantages. They hold investments for over a year to get long-term capital gains rates instead of short-term rates. They invest in municipal bonds that are tax-free. They use strategies like tax loss harvesting, where they sell losing investments to offset gains and reduce their tax bill. They donate appreciated stocks to charity instead of cash to avoid capital gains taxes while getting a deduction. All of these strategies are completely legal and available to anyone, but most people never learn about them. Over a lifetime, being smart about taxes can save you hundreds of thousands of dollars. That's money that stays invested and continues compounding instead of going to the government. Wealthy people also understand leverage, but they use it carefully. Leverage means using borrowed money to invest, and it can be powerful or dangerous depending on how it's used. For example, when you buy a house with a mortgage, you're using leverage. You might put 20% down and borrow the other 80%. If the house appreciates, you earn returns on the full value, not just your down payment. That's good leverage. Wealthy people use this concept in various ways. They might get low-interest loans to invest in businesses or real estate when they believe the returns will exceed the interest cost. But here's the key. They're very careful about it. They don't over-leverage themselves to the point where they could lose everything if things go wrong. They calculate risk carefully and never bet more than they can afford to lose. For beginners, I'd be very cautious about using leverage. It's something to understand and maybe use later once you have experience, but it's not a starting strategy. Another thing wealthy investors do is they have a team. They don't try to do everything themselves. They have accountants who handle their taxes, financial advisors who help with planning, attorneys who handle legal matters, and sometimes investment managers who oversee portions of their portfolio. This might sound expensive, and it can be, but it's an investment that often pays for itself by avoiding costly mistakes and optimizing their financial situation. Now, as a beginner, you probably don't need a whole team, but the principle is important. Don't be afraid to pay for good advice when it comes to complex financial decisions. A good financial advisor or tax professional can save you more money than they cost. The key is finding people who are fiduciaries, meaning they're legally required to act in your best interest, not just sell you products for commissions. Let's talk about something that might surprise you. Wealthy people often have a significant portion of their wealth in boring, stable investments. Everyone sees the flashy stuff, the sports cars, the luxury homes, but those are usually a small percentage of their actual wealth. The bulk of their money is in things like index funds, bonds, and real estate that steadily appreciate over time. They're not gambling with most of their wealth. They might take calculated risks with a small portion, maybe 10 or 20% in more speculative investments, but the foundation is built on stable, proven investments. This is the opposite of what most beginners do. Beginners often want to get rich quick, so they put all their money into risky stocks or crypto, hoping to hit it big. Meanwhile, wealthy people are perfectly happy with 8 to 10% annual returns compounded over decades because they understand that's how you actually build and maintain wealth. Here's something about the wealthy investor mindset that's really important. They don't get attached to investments emotionally. If something isn't performing or the fundamentals change, they sell and move on. They don't fall in love with stocks or hold on to investments hoping they'll come back just because they don't want to admit they made a mistake. This is hard for most people. We get attached to our decisions and don't want to admit we were wrong. But wealthy investors are ruthlessly practical. They evaluate investments based on whether they're still the best place for their money right now, not based on what they paid or what they hoped would happen. This doesn't mean they sell constantly. Remember, they think long-term. But when the thesis for an investment changes, they adjust. Wealthy people also value liquidity. Liquidity just means how quickly you can convert an investment to cash if needed. They make sure they have some portion of their wealth in things they can access quickly. This might be cash, money market funds, or stocks that can be sold immediately. They don't tie up all their money in illiquid investments like real estate or private businesses where it would take months or years to sell. Having liquidity gives them options and flexibility. If an amazing opportunity comes up, they have cash to take advantage of it. If there's an emergency, they're covered. For beginners, this means don't invest money you might need soon, and always maintain an emergency fund separate from your investments. Here's a strategy that wealthy people use that's available to anyone. They automate their investing. They set up automatic contributions to their investment accounts every month without thinking about it. This removes emotion from the equation and ensures they're consistently investing regardless of what the market is doing. It's the same principle as paying yourself first. Before they spend money on anything else, money automatically goes to investments. This is probably one of the easiest wealthy people habits to copy. Set up automatic transfers from your checking account to your investment account every time you get paid. Start with whatever you can afford, even if it's just $50 or $100. The automation is what makes it work because it removes the decision-making and temptation to skip months. Let me tell you about opportunity cost because wealthy people think about this constantly. Opportunity cost is what you give up when you choose one thing over another. If you have $10,000 and you spend it on a fancy vacation, the opportunity cost is what that money could have earned if you'd invested it. $10,000 invested at 8% annual returns becomes over $100,000 in 30 years. So that vacation didn't cost you $10,000, it cost you $100,000 in future wealth. Wealthy people think this way about purchases. They don't necessarily deprive themselves, but they're very aware of the trade-offs. They ask themselves, is this purchase worth more to me than the future wealth it represents? Sometimes the answer is yes, but they're making that decision consciously, not just spending without thinking. Wealthy investors also understand that investing isn't just about picking the right stocks or assets. It's about having a comprehensive financial plan. They think about how much they need for retirement, how much they want to leave for their kids, what their life goals are, and they build an investment strategy around those specific goals. They're not just randomly investing and hoping for the best. They have targets, and they work backwards to figure out how much they need to save and what returns they need to hit those targets. This kind of planning is available to anyone. You can sit down and figure out how much you'll need in retirement. Calculate how much you need to invest monthly to reach that number based on reasonable return assumptions, and then execute that plan. Not complicated, but most people never do it. Before we wrap up, I need to mention that everything I've shared here is for educational purposes only and not financial advice. I'm not a licensed financial advisor, and your situation is unique. You should do your own research and consider consulting with professionals before making investment decisions. My goal is to show you how wealthy people think about and approach investing, not to tell you exactly what to do. So here's what you should take away from this. Wealthy people invest differently not because they have secret access or special knowledge, but because they have different habits and mindsets. They diversify across asset classes, they invest for the long term, they focus on tax efficiency, they generate passive income, they invest in themselves. They stay emotionally detached from investments, they automate their contributions, and they have comprehensive plans. All of these strategies are available to you right now regardless of how much money you have. You can start investing in index funds with $100. You can open a Roth IRA today. You can automate your investments. You can learn about tax strategies. You can start thinking like a wealthy investor, even if you're not wealthy yet. The difference between staying where you are financially and building real wealth over time often comes down to these habits and mindsets, not to how much you start with. If this video opened your eyes to how wealthy people actually invest, and you realize you can start using these same strategies, I'd really appreciate it if you hit the like button. And if you want to keep learning about building wealth, smart investing, and financial strategies that actually work, subscribe to the channel. In the next video, I'm going to show you exactly how to build a wealth-building portfolio step by step. Using the principles we talked about today, even if you're starting with very little money. Thanks so much for watching, and I'll see you in the next one.